All right, so right now it's 8 p.m. already. So let's start for today's session. So before we start, today we are going to have a topic how to look for mid and small jewel stocks. So we have invited Max from Want to Invest to share with us about this topic. So before we start, so you can actually see over here on the right hand side, there is a QR code, right? So this Telegram group is actually our Telegram group where it's called Stock Market Buddies. So in this Telegram group, right, we will actually always share a lot of information regarding the global market, Singapore market, Hong Kong, or even Malaysia stocks information. So if you are interested, you can actually just scan for this QR code and then just join for this group. So you can come over and discuss with us about the stock markets, and we will share with you more info. All right. Okay. So without further ado, let's invite tonight's session. Hello, Max.
Hi, Darren.
Hey, hello, Max. How are you?
Hi. Doing fine, and good evening to all participants here. I don't know if you guys can tell from the voice. I'm actually kind of a bit sick today, but again, very thankful to Darren and also Investing Note. We got another very good analyst to kind of stand in for later part as well. So I'll leave the part for Darren to introduce later on. But once again, good evening to everyone.
Yeah. Yes. So for today, because unfortunately Max is not very feeling well, that's why we have invited one of our friend, Vincent. He will be actually to share more information about this as well, because his expertise and he is very focused in studying some of the mid and also small caps stocks. So I believe later after Max sharing and together with Vincent's sharing, you will be able to get more information today. So without ado, let's start. Max, are you ready?
Yep, all good.
Sure. Yep. I'll just pass the sessions to you.
Okay, right. Let me just share my slides real quick. Okay, just a quick mic check, if you can hear me loud and clear, can you just type in a 1 so that I can, proceed accordingly? Whether you're on Facebook or you are in the Zoom right now, if you can hear me loud and clear, you can type in a 1 or just say hi so that I know you guys can hear me. Okay, cool. Okay, great. So again, good evenings, ladies and gentlemen and fellow investors. So I hope you are doing well, in this very challenging market, to say the least. Now, again, first off, thank you very much to Investing Note for organizing this and providing me a venue to share a bit about on the topic on how, as an investors, how should we look for mid and small jewel stocks, or so-called hidden jewels, especially for the Singapore market itself, which is a very interesting and unique market. So in today's session, what we'll cover is, I'll try my best to cover the full spectrum if I can. We share a bit about the rationale of choosing, mid and small cap companies. Why should we choose them? And some of the metrics that we will look into, and as well as if you have the time, we'll discuss a bit about case studies, but I'm more than happy to address your questions first if you have any questions with regards to the topic we're having today. Okay. But before it officially begin, I want to go through a very quick disclaimer, just a very quick disclaimer. By all means, anything, and especially stock itself, any stocks that we mentioned today, by all means, they are not buy, sell, or hold recommendation and should not constitute as any form of investment advice. Now, if you need any form of investment advice, you need some financial advisory, I would strongly encourage you to engage with your dealer rep or perhaps your financial planner instead. Okay, so very quick disclaimer here. Okay, for the benefit of those who have never met me before, perhaps you've seen me in with another talk yesterday, but if this is the very first time you've seen me, my name is Max. I personally, I started my financial journey from graduating a diploma from Thai UC. I wonder if any Thai UC friends here as well. So after that, I went into the SME financing industries. This is my actually 7th year investing in the stock market. Not only stock market, I also actively invest in other class of equities as well, like pre-IPO, ECF, and also some P2P projects as well. So We also have a platform called Want to Invest, as Darren mentioned just now, where we have over 60,000 followers to date since our commencement in 2019. And we had the opportunity to, host over 50 companies. And we will be hosting AutoCount tomorrow, which is an IPO to come on our platform. So these companies, they're coming from Bursa, Nasdaq. And for now, personally, I'm also a SGX Academy trainer. Okay. So without further ado, let's go straight into the topic that we will discuss today. So let us first define what actually are small and mid-cap car companies. Okay, so you might wonder what is actually the definition itself for small and mid-cap companies. How can we define them? What kind of metrics should we define, small and mid-cap companies? So by quote unquote official definition, small companies, small, mid, and big cap companies is actually by market capitalization, which small market cap is anywhere between 300 million to 2 billion. And then for mid cap, it will be 2 billion to 10 billion, and big obviously will be 10 billion and above. So anything below the 300 million market cap mark, we call them micro companies, just for reference. Okay, but if you think about it, actually market capitalization may not be the best, the metric for us investors, value investors ourselves. It may not be the best metric to, categorize them as small cap, big cap, or large cap. So why is that? If you take the market capitalization's formula itself, it derives from two key criteria. The first one being number of shares outstanding, or NOSH, what we call NOSH, number of shares outstanding. And the second one being the share price. So obviously, as you know, share price itself could fluctuate from day to day, and it's always influenced by what we call emotions. Okay, greed and fear, obviously, optimism, pessimism, and also some euphoria during special times, also mega panic during unconventional times, to say. Okay, so if you were to justify a company just purely based small and mid cap, purely based on market capitalization, you might miss out on some of the companies because they might have a very small market capitalization because no one is actually looking at them yet. They are being under the radar, so-called under the radar. No one is looking at them yet, or they could have a very large market cap due to some reason. There are a lot of interest into the share itself, though. That's why the share price inflated, which would ultimately converts into an increased market capitalization. Then the company itself, it will have a larger market cap. So if you ask me personally, I would prefer to look at the revenue or other financial metrics of a company to define them, as a small, mid, or large cap company, right? So how do we actually quantify them? Now, quantifying the small, mid, and large cap companies actually is quite subjective and on person-to-person basis. But for me, myself, and for ease of understanding today, normally I would categorize anywhere below 500 million in terms of revenue. I would categorize them as a small cap company. And 500 million to 1 billion, I would say somewhere they are in the mid-size, maybe in the growing stages now. But do take note that when a company, they have different business model, they would typically have a different revenue size, which is obvious, right? But let me give you an example. If you are taking a company that is in the trading business, okay, so buy and sell, basically in the trading business, naturally they would have a larger revenue base. Okay, so they will have a larger revenue base. And for companies that are in services industry or very high technology industry, perhaps their revenue will be smaller, but vice versa, their margin will be much lucrative as compared to trading companies. So to me, I'm more to a bottom-up person. Bottom-up person meaning that I will look into the company first, then I will look up to the industry. What is the growth like? I'll elaborate a bit more later on in terms of how do we identify this kind of companies later on. But generally speaking, a lot of factors that actually goes into the categorization of small, mid, and large cap. Okay, but one of the metrics would be revenue itself, and after going through a revenue, you should go through the business model to understand whether it justifies or not. Okay, and also one thing that investors should always take note is that profit and cash flow itself should always override the revenue size, no matter what kind of company you are choosing. So imagine this: you're running a company now, and your company is having a multi-billion revenue size. Okay, but in a sense of you are having a multi-billion revenue, let's say your margins are very low. So your margin of error, we'll discuss this a bit more later, your margin of error will be very minimal. So that means that if you have one delivery of your stocks, if you manage to screw it up, then you might suffer losses. So margins and ultimately profitability is very important. Okay, but generally speaking, I think if you're looking at small and mid-cap companies to invest in, I think, and companies that are in below 1 billion revenue, I think they are very good for you to start with. Okay, but here comes the question: why would you look for small and mid-cap companies to put in your portfolio? Why not just go for large cap, go for mature companies, go for REIT itself? And Singapore had a lot of fantastic REITs that offer you good yield, and they also have some tax incentive for non-resident investors as well. So why should we go into small and mid-cap at this juncture? So let me first explain the rationales of why us as an investor with limited capital should seriously look into small and mid-cap companies. But first, let me explain why not large cap companies first. Okay, so logically speaking, large cap companies, they are companies that have achieved a certain revenue size or a certain profit size. So the company would normally be valued as a large cap by the market now because they have a very large revenue size, profit size, and of course they have a certain economies of scale, right? Now, imagine this: if you're investing into a company with a revenue size of, let's say, for example, 2 billion, what would a 10% growth represent? Okay, 2 billion in revenue. Next year, the company is targeting to grow by 10%. That would mean that the company will need to hit an additional 200 million in revenue to grow by 10%. Okay, now take a step back. If we were to look at small and mid-cap companies, the company itself, they are interested to grow at the same rate, 10%. So let's say the smaller company now, they have a revenue size, a base revenue of 200 million. For them to grow by another 10%, it's obvious that they only need to grow by 20 million, right? So 10% of 200 million is 20 million. So if you think about it rationally in a effective market, would it be easier for a company to grow 20 million in revenue, or would it be a company to grow 200 million in revenue in the same industry? So normally, under fair circumstances, to grow a 20 million revenue is much more easier to achieve than 200 million. Okay, so this is one of the rationale as to why I would normally prefer smaller companies, because in order to achieve the growth that they are targeting or whatever growth that they are aiming, it will be much easier as compared to large cap. So very rarely you would identify the companies in whatever market you are in. Very rarely you can identify the companies with mega scale revenue, let's say 1 billion, 5 billion, to grow at 10%, 20%. They are super rare. Okay, once they reach a certain scale, even for some of the companies in the US, the mega technology companies, once they hit a certain scale, they will have a slow down reduction in speed of growth. So if you're looking for capital gain and more aggressive kind of investment, so I think small and mid cap companies are some of the better investments that you should look for. Okay, now for me, the return for investors is always coming from where? It's not necessarily revenue. In fact, if you ask me, revenue sometimes it doesn't bring any value to you unless it was translated into profit, cash flow, as well as some of the growth opportunities, things that will be factored into the share price by investors. Okay, for growth opportunities, naturally it will be forwarded into a forward valuation. This we'll discuss in a bit later in terms of valuation later on. Okay, and usually how investors, let's take you and me for example. How do you value a company in terms of growth? Normally you would not go to a company and say, oh, this company grows by another 100 million this year. Normally you would justify in terms of percentage, right? So in order to for normal market circumstances, and provided the valuation of the company remains the same, right? For a company share price to increase by 20%, what needs to happen? The EPS, earnings per share. So the formula is net profit divided by number of shares outstanding. So EPS have to grow by 20% to carry in tandem with the share price to grow 20%. So it's quite straightforward, right? So your capital gain as an investors would naturally come from the increase in terms of EPS. So back to the question just now, which one is easier to grow? I would say smaller companies. So this would sort of justify my very personal rationale in terms of choosing small and mid cap companies. Normally, this kind of companies, to be fair, they will bring you a higher opportunity in your profitability in investment, but at the same time, they will carry a higher risk because it might not materialize. As compared to larger companies, it's easier for them to sustain their revenue in a sense. Compared to smaller companies, they are going aggressively, so a lot of costs will involve, etc. So I would say the risk and reward would increase in tandem, but if you are looking for higher growth, definitely, in my opinion, small and mid cap are more makes more sense. So again, coming back to business perspective, if you are a businessman, for those businessmen that are in the session here, if you're not, don't worry. But just very common sense coming from a business perspective, it's always easier to for a newer company to increase their market share as compared to a mega scale company that, let's say, market leader that retain a market share. So let's think about it. If a company now they have less than 1% market share in the market, okay, is it easier for them to double their market share, or is it easier for the market leader to double their market share? In this kind of scenario, the market leader will be thinking, how can I defend my market share, instead of thinking of doubling. But for the smaller companies, doubling in terms of market share, provided the total addressable market, or we call TAM, provided the TAM doesn't have too much changes, right? Normally, this kind of scenario, it will be easier for the smaller companies to double their market share, okay, provided the TAM remains the same. Now, the bigger companies, yes, they are big, but they would be thinking on how should I defend my market share instead. Okay, it's not too much towards, I'm going to double my market share even though I'm the market leader now. Your perspective of investment is just not the same, okay? Of course, in real life scenario, a lot of other factors are involved, but this is just an example for you to have a better understanding on the rationale and some of the key points why to invest in small and mid cap companies. Now, another example that is more realistic to me, I think, is when you pick small and mid cap companies, sometimes you would enjoy opportunities that market sort of overlook. I'm not sure if you agree with me, but if you're in the market for long, you will notice that normally bigger companies, they are sort of fairly valued already by the market. And this is due to more analyst coverage, more media coverage, more people know about them. Their brand names, obviously, they're well known, right? So anything happen to the company, it would be reflected into their share price very, very quickly. So it's quite efficient. I do not believe in perfect, market efficiency theory, but for larger companies, they will be more efficient because whatever information that there is regarding to the company, it will be reflected more quickly as compared to, companies that are smaller in scale, that lesser people are actually looking at them. So take, for example, some of the companies that you might not heard of, but they are actually doing pretty decent, right? So these kind of companies, because of their smaller market capitalization, sometimes they are not even in, the fund manager's so-called investment universe. This is due to, mandate restriction and whatnot. And also some analysts, they couldn't, they are not looking at it. So when analysts and fund manager, they are not looking at a company, naturally, the exposure for the company towards investor decreases. Unless they have some very aggressive, investor relation activities going on, then it will be a sort of a different scenario. But normally that will not be the case. Okay, so why is this so important? Why should we look into company, whether people are looking into it or people are not looking into it, whether they have exposure or not? So the reason is very simple. The lesser the people that are looking into this company, okay, it'll be, sorry, the lesser the people that are looking into this company, the lesser the people would realize the value of this company. So imagine this, if you are looking into this company, you realize that this company is in the right trajectory, in the right market, enjoying super normal growth, but because of no one actually look at the company yet, so the valuation is quite so-called undervalued now. Okay, so these are the market inefficiency opportunities that you can find in small and mid-cap companies that normally it's harder to find in terms of big and good exposure larger cap companies, right? But vice versa, it is also easier for you to buy in a overvalued company because again, the efficiency is not as good as larger cap companies. So the company valuation could or could not be inflated as well. So you have to really be careful about this, right? So another reason for me to put some of the small and mid cap companies into my portfolio is because of a diversification. Normally, when we look for stable, if I want to preserve my wealth, or I want to go for cash flow investments, for example, in the form of dividend or distribution, by rates, by very cash-rich companies, I will go for larger caps. This is because when I go for this kind of company, whether to preserve my capital and to go for cash flow, I would want to look for companies that have more stable revenue stream, stable profitability, and stable cash flow, as compared to growth companies that might have up and down all along the way. So but that doesn't mean that your portfolio should only consist of cash flow. Of course, that depends on you, right? Depends on your age and also your risk profile. But if you are in a younger stage and you really look into having capital gain in your portfolio, you should seriously consider having a diversification of small and mid-cap companies into your portfolio itself. Okay, but having said that, well, Max, you talk about small and mid-cap, it sounds fancy, but how do we identify these kind of companies? Okay, so typically there will be two ways, commonly known two ways that investors can actually look into these kind of companies. Okay, the slide here, I'll explain it in a bit, but let me explain a bit about two ways that you as an investor could identify these kind of opportunities. Now, the first way is obviously from gathering news from all the public sources, right? For example, if you notice that there is a shortage in terms of a precious metal, okay, if you are a trade investor that you're in the market for long, immediately you know that, okay, now company ABC, they have a certain, it might not be their largest revenue contributor, but maybe like 30-40%. They have a certain exposure in this raw material. Now I have to figure out whether they are the supplier of this raw material or they are the processor of this raw material. There's a huge difference. If they are a processor of this raw material and there is a shortage, chances are they might suffer from the shortage as well because they couldn't get the raw mat, right? And if they are the supplier themselves, then the scenario is different. What does shortage mean? It means scarcity. Scarcity would normally translate into higher pricing. In terms of ASP, we commonly call ASP. I'm sure all the glove investors here knows about the term ASP. So higher ASP translate to higher profitability. So these are the opportunities, ways that you can actually get from the market. So I'll give you another example that you can get from the news. So as and when you saw the news talking about, oh, the oil price had increased again, how much per barrel in terms of Brent oil, there's a shortage, there's a war, etc., that increases the oil prices. So what should you do at this juncture? You should look into, first thing, the upstream companies, oil and gas companies, those who produces oil, because they are the direct beneficiaries, right? But secondly, you can also look into those mid and downstream. What do I mean by mid and downstream? So midstream in oil and gas, typically we're talking about storage and also tanker. And downstream, it depends on how you actually talk about it. It could be servicing industry. It could be the downstream, cracker, and also the petrochemical companies. Okay, so these companies may or may not benefit from the oil price changes itself from the upstream. So from news itself, obviously you can also identify some of the potential companies that you can invest into. But that is one way, and I think it's not too consistent. If you are an active investor and you want to look for a more consistent and a more predictable way to actually look for good investments, I would say that actively filtering companies will be a better way. Now, I'm sure a lot of tools, good tools that that are available in the market. Later on, you guys can ask Darren about the software. But if you are looking to some generic tools that you can look into the market, perhaps Yahoo Finance, and also Singapore market itself, they have a lot of tools for you to filter all the companies by your own set criteria. Okay, so for the benefit to those who are new to the market, please allow me to share a bit about some of the metrics that I will actually look into when I'm investing into the small and mid cap market. Okay, so the first one, as I mentioned, I'm more of a bottom-up person. So normally I would look very seriously into the business model of any company. Now, okay, let me explain a bit more about business model. I think this is one of the under discussed topic that amongst a lot of value investors. Okay, so the quarterly report, the annual report, or whatever report that you've seen the company publishes, normally they are delayed in nature, right? For quarterly report, you have a 2 months delay, typical. For annual report, you have a 4 months delay after the company closed the financial year, typically. So all these financial results and all these reports, they are often what we call after effects, quote unquote, after effects, or after results of what had already happened in a company. Yes, initially you can definitely review the documents to understand more about the company itself, and perhaps you can take it as a reference. But if I were to ask you to predict the profitability and also growth of a company based on numbers alone, I think it will be very, very difficult. Of course, if you are a mathematician, then it could be a different story. You could have your own, financial model. But for general investors like us, it will be very, I would say, extremely difficult to try and predict the earnings of a company. Now, why do we need to predict the earnings of a company? When we are investing, typically we are not selling in the company next day, right? That would be trading. So when we are investing in a company for long, we need to sort of have a certain capability to predict the future outlook or future performance in terms of financial performance, and also growth opportunities of that company over a longer term. So your ability to actually understand the company and sort of predict the future of the company is really, really important. And one of the excellent ways that I think that you could predict or project the future, quote unquote, project the future, future value of a company, that would be looking into the business model of a company. Okay, so the more you understand about a business, whether it's on micro level means the company level, or macro level, which means the general industry as a whole. On micro and macro level, the more you understand, the higher chance that you could predict about the financial performance of that company. There will be a much higher chance for you to successfully predict that. Of course, 99% of the time you won't get the exact figure, but if your trajectory is right, so typically you can ride on the growth of that company along the way. Okay, so some of the business model that I would, I'm not saying they're bad, but it really depends on the scenario before I invest into them or not. Okay, take for example, let's say commodity companies. Okay, now to invest in commodity companies, commodity-based companies, you need to have a extremely good understanding on the macro level. I will give you an example. For example, steel. You need to understand steel itself. What is the consumption outlook going on? Will there be more demand, or will there be slower demand in the shorter term itself moving forward? So let's talk about maybe the CPO. CPO, obviously, at the time, if you understand about the supply and demand metrics at the point of time, so definitely you may be benefited from it by then. Obviously, that is because you are able to sort of foresee the demand. Demand and supply is very important in the commodities market. So at the point of time, you are able to sort of have the understanding of whether the company will perform well or not in the future, right? And some of the business that you could seriously consider moving forward, right? I think they could be manufacturers and solution provider to a 5-year ahead problem. So what do I mean by that? I'll give you an example. So the EV industry, they are typically a solution to the environment. Actually, EV itself, the oil prices plays a role in terms of the growth of EV, but obviously that's a political topic, so we're not going to touch on that. And if you look into the EV industry itself, it promises a solution to 5 years problem ahead. Okay, so naturally there will be a lot of investment. There are a lot of interest into it. Now, take a step back. Let's look into the Malaysia market. If you are living in Malaysia, you will notice that the renewable energy RE industry in Malaysia is doing quite well. They are doing quite well, especially for EPCC. Basically, what it means is full scale EPCC industry for the solar industry. So, but although they are in the right industry, but the number of EPCC player in Malaysia has actually increased drastically. So there is actually a lower barrier of entry. So when you have a lower barrier of entry, you would have a challenge in terms of maintaining your margin. So think of it, the total addressable market is there, but when you have more competitors, they would reduce your market share effectively. That being said, there are very few EPCC players that are still performing well, but they are really rare breed. I think another example that industries that you could look into could be the fintech. Singapore itself, they have a lot of fintech companies. They would solve the issue of the cashless and also security transaction and all. Another easier example for fintech, maybe there are banks that are moving aggressively towards the digitalization. They are more prone towards to secure a younger customer base. Effectively, it will transfer into better CASA ratio, right? So it would sort of boost their growth in the future, right? But after the business model part, I think coming back to financial metric itself, it will be also important to look back at the financial metrics. If you only look at business model, there will be no difference for you to invest in a SPAC, let's say in the US market, because you are buying into the future of a company without looking into the financials. Okay, you can refer, as I mentioned just now, financial metrics, they are a very good point to start for referring into a company, but I would always rank business model over. It depends on people. You could mix and match around the metrics in terms of ranking, whichever you like. Okay, so what are some of the financial metrics that I personally would look into? I will look into the growth of the company for the past 5 years. At very, very minimum, for new IPO companies, I will look at the company's growth for the past 2 years. Now, unless there's a sudden surge in terms of demand for a product or services for the company, for example, like out of nowhere pandemic happens, those black swan events that would boost the company's financial performance significantly. So that's those are extraordinary events. But under normal circumstances, again, you should look back into business model. Do they solve a fire problem? Then you look into their previous financial performance. Are they already growing previously? Are their financials prudent? So what are the things that I would look into? For example, like I would say would be revenue first. Are they growing in terms of revenue? Although in the okay, I give you a more tricky scenario, kind of company. The company's revenue has been stagnant for the past 2 years, but they are to some extent it's actually declining even, but they're in the right trajectory. They're actually into the EV value chain, but their revenue is declining for the past 2 years. So you have to find out why are they declining in the past 2 years. Is because they are doing R&D at the point of time. So once they completed the R&D, their revenue increased drastically afterwards because their new product is ready for the market, and there's a very good growth opportunity for them at the point of time. Okay, so in that case, there'll be some sort of special case, but generally speaking, I will look for companies that have a record of them having the product, the services that are growing consistently. So the next thing is perhaps the profit margin. Profit margin is more important to me, where if you look at a lot of companies, right, if their profit margin is too low, a drop in revenue could mean a huge change in terms of their PAT, because their margins are, too, I would say let's say a EMS company with 3% margin. Now imagine a 1% drop in terms of profit margin. It would mean 33% slash in terms of their profit after tax, even though there's only 1% changes in terms of profit margin. So profit margin to me is really, really important. I would typically look into companies that have a 10%, 10 to 15% and above profit margin to protect myself, and also their profit itself must be growing. Okay, if not, take for example the recent problem that a lot of companies face would be the utility costs that are increasing. So if your margins are too low, you suffer from the higher utility costs because you may or you may not pass on the cost to your customers. If your margin is too low, there's a chance for you to go into losses, right? Then the next thing I will look into is perhaps the cash flow. Okay, cash flow is especially important for a lot of companies. You might see them having growth in terms of revenue, having growth in terms of profitability, but if they do not have cash flow consistently for, let's say, past 1 or 2 financial year, then the company is definitely doing 2 things. 1, they are actively raising funds for the market. 2, they're increasing their bank borrowing, which the bank borrowing itself, it carries an interest, right? So your interest expenses increases, your margin would decrease, your profit after tax would also decrease. So if a company doesn't have a positive operating cash flow, always be careful. It would mean something is not right if a company is able to grow, but for the past 2 or 3 years, they are not able to generate a operating cash flow. When we talk about trade receivables, it doesn't matter if it's 60 days, 90 days, even 180 days, and 1 year in extreme cases, okay? Payment terms of 1 year, it's very extreme. I doubt there are a lot of companies that have this kind of payment term. Typically, it's 90 days to 120 days. So if they exceed the payable days, so-called collectible days of what I mentioned just now, so there's a good chance that it would default, the client would default, or something is just not right in terms of their account. So you have to be really, really careful about it. Okay. So another metric that I would look at, it would be ROE itself, return on equity. So return on equity, if you look at that's a lot of there's two formula for ROE itself, but if you look at the simpler one, which is the net income divided by shareholder equity, so you will see that how efficient a company in terms of deploying their equity or your net asset to say. So in this case, the ROE normally plays a very important role, but again, subjective to industry. Okay, ROE, it shows that how good a company in deploying their assets. So the higher the ROE, it means that a company gets more return from lower assets, but always be careful because companies with higher borrowing, okay, because it's a liability. So how do you get equity? So asset minus liability equal equity, right? So when you have a company that have a very high debt, almost on par with their asset, you will get a very high ROE because ROE, when you divide by the net asset is small, right? The base number is small. So the ROE will be high. Be very careful on that. Always study on what kind of industry you are studying at and the ROE, whether it makes sense or not. Okay, so if you are into the property industry, naturally their inventory, let's say land bank, houses, they will be a high asset base. So the ROE normally will be lower, okay, for their cases. So really subjective to the company itself into ROE. But ROE is again very important for them to check whether they deploy their assets effectively in that sense, right? So the third pillar is normally the hardest for you to actually quantify the quality of the management. Like how do you quantify if a person is good or a person is bad? There's just no simple scorecard that you can just think, okay, this guy is good, and you wouldn't know as and when they are lying or they're not lying. Okay, some of the ways that to reduce our risk, we still need to assess the management regardless, even though it will be tough. After the COVID-19, actually a lot of companies, they moved the AGM or EGM onto virtual basis. So if you have the time and if you are available, please attend the AGM or EGM that is available to you so that you could sort of, first thing, you could get some updates into the company you invested into. Secondly, you can actually go through whether the company, what they speak, are they speaking prudently? How do they treat the shareholders themselves? And are they over promising something? Like if you attend 3 to 4 AGMs in a row, right, you would know that what the management said back in 1 or 2 years back then, and if they delivered so far. And if you really don't have the time to do that, just look into their annual report, MD&A, management discussion and analysis part. Normally MD&A part, they would share with you as well in terms of what are plans of the company, the growth plans. So if a company is consistently failing to deliver what they promise, that is a red flag to me for the management, except for extreme cases like COVID-19, that would be a extreme case. But in normal cases, if they all promise and under-deliver, so watch out for that. That's a red flag for me in terms of choosing for a very good management team. So alternatively, if you have the connection, you can also ask around the industry peers, how does the management actually show their true colors across the industry itself. Okay, but again, back to small and mid-scale company itself, they tend to promise you very sexy growth for the future, but there's also a larger risk for them to overpromise you in a sense. So when they overpromise you, normally the valuation, which is the next topic we'll touch on, will be inflated. And when you invest in a company with inflated valuation or inflated expectation, then your risk itself would increase if they fail to deliver what they promise. Okay, so lastly, we'll move into the valuation part. So for growth company, especially in the small and mid cap companies, I think the most important valuation metric is PEG, price earnings to growth ratio. So you might ask me, does NTA doesn't matter to you? Does dividend yield doesn't matter to you in this context? In my personal and very personal opinion, If you are looking at NTA, net tangible asset per share, and if you are looking at dividend yield, might as well you look for larger cap companies, because as I mentioned just now, larger companies, they are more stable in a sense, and they normally are able to, give you a more stable dividend, more stable cash flow. And if you're looking into larger NTA companies, so what you're thinking is perhaps you're waiting for privatization, or perhaps they will sell the asset and issue a special dividend to you. So this normally would not happen in small and mid cap companies, as it's really, really rare to happen in that. So it's more realistic for you to use the PEG metric. So PEG is simple: price to earnings of a company divided by the growth rate of that company. So for example, if a company is having a PE of 30 times, and the growth rate of the company expected to be 30%, so the PEG ratio of that company would be 1 time. Okay, will be 1. Ideally, you want to look into company with a PEG of 1, so that means that you are not overpaying for that company itself. But as you know, things may never go as it planned, right? Be very careful when you're buying into any company with PE of 30 and above. Okay, when I say PE 30 and above, it excludes the additional factors such as one-off losses in their past quarters that will cause a lower trailing EPS, effectively a higher PE ratio. Okay, those are exceptional cases, but in normal circumstances, if you are buying into a growth company with a 30 times PE and above, that would mean that the company is actually enjoying higher market expectation at the moment. So once they fail to deliver what they promised, the valuation would immediately get deflated, and you as an investor, you will suffer a capital loss. Okay, in terms of when they re-rate the company at a lower growth rate, so naturally the PE of the company decreases, the valuation of the company decreases in terms of share price. Okay, so back in 2021, a lot of semiconductors, they generally enjoy a supernormal growth. There's a super demand, whatever semiconductor industry you're in. So some of the companies, they enjoy supernormal valuation as well. But if you were to carry on with the investment from then, if you invest in the peak to now, with inflated valuations, I think you generally will suffer a quite huge capital loss. So be really careful when you look into companies with inflated valuation, generally speaking. Okay, so I think I'll pass on back to Darren. Actually, I wanted to share a case study, but unfortunately, really not feeling well to finish up. But to those who attended, perhaps Darren can later on in the next week, I'll share with you a research report about this company done by my own. But by all means, it warrants no buy or sell or hold recommendation. It's just pure sharing on this company myself. Okay, so yeah, Darren, I'll pass it back to you.
Thanks, Max. Thanks for the 45 minutes sharing. I think you have covered a lot and shared a lot on the knowledge about your thoughts about that. So rest well. Okay, drink more water. All right. Thanks, Max. So next, right, I will pass it to Vincent. So for those who first time meeting Vincent, right? Vincent, maybe you can do a very quick introduction about yourself.
Yeah. Hi, people. Good evening. My name is Vincent. I'm a research analyst from Investing Note Singapore. Just a short introductions about myself. I was a chef in Malaysia. I'm Malaysian myself for 10 years, and I fell in love with investing. So I love it so much that I go to Singapore and get an accounting cert, and subsequently working there. Yeah. I think that's it. Let's get to the.
Thanks, Vincent. So
Yeah.
I think maybe Vincent, you can also continue on what are the Max have left, right? So I think you also have a very interesting thing to share as well. So I'll pass the time to you.
Sure.
Thanks,
Okay,
Vincent.
let me share screen first. So first of all, like every educator, this is a disclaimer. So like Max say, do your own due diligence and basically just say, don't trust everything I say. And so you guys won't sue us. And okay, so I'm also, beside research analyst, I'm also an editor for a website called Investor One. Is focusing, I'm writing the articles for small cap stocks in Singapore, a public company that listed in Singapore. So I just want to add on to what Max already established. Do you guys know that how many stocks there are in US, which is largest equity market in the world? 40% of capital in the world is in US. Actually, there are 4,000, around 4,000 or 5,000. But do you know how many hedge fund just in US alone? There are like 14,000. Let me remind you, that is not an individual like retail investor. That is not like some, including some banks or institution which also invest. That is hedge fund. Those professionals from Ivy League, from reputable university, that's smarter than me, probably smarter than some of you. So just tell me, if you want to beat the market, you want to beat other investor, right? Would you like to like beat the those high flyer, or you rather choose to beat the amateur? It's like you're playing poker. Are you want to play with professional poker, or you want to play with amateur poker? I think the answer is quite simple. In order to you want to make more money, probably you want to play games with amateur. So like Charlie Munger say, this is he's my idol, by the way. He's also a right hand man of Warren Buffett. And don't go where the big boys have to be. You don't want to look at the drug pipes of Merck and Pfizer and go where there are efficiency in which you can get advantage, and where there are fewer people looking at the stocks. Go where the competition is low. And some, like, because if in the small cap stocks, in order for the big funds with high flyers to invest in it, they have like 1 billion, 2 billion, or 5 billion share of pool of capitals. If they want to invest in the 50 million cap stock capitalization stock, sorry, my my tongue, they will even when the stock go up like 5 or 6 times, they gain nothing, they gain very little. But to you, that's a different story. Probably you get few of those, it probably change your life. Maybe you could retire earlier, right? But that's a big but. Once you invest, once you get out of US equity market, there's one thing you need to be clear before all those financial metrics, before you learn all those financial accounting knowledge, is that you have to know the integrity of the management. In US, it is different story. You have all the activists who will protect you. So that's in 1970s. There are guys called Mike Milkens that issue all this junk bond so that everyone can borrow a lot of money to be a board member of the companies. So they just slap all those lazy board directors, board members, like just like slave driving them to earn them more monies. But outside of US market, some company like maybe Malaysia, maybe Indonesia, maybe Singapore. Not say that they are fraud. Some maybe are not really efficient in using the investor money, right? Because if you buy an equity, you are the boss. Maybe you are very, very small boss, but you're still a boss. Maybe 0.0001% boss, but you're still a boss. But they have to work for you. They have to work for your equities. But some maybe probably just trade the equity like their own personal wallet. So in order to know what the my boss Ethan investing note once told me that CEO is the largest is the best marketer. They always tell you the fancy thing. They always tell you how good they are. They how how wonderful their company is. But it's better to look at what they did before rather than what they say. So the best things you can do is probably look at their history, how they work their money, what is their ROE looks like. Is a very important indicator. Maybe if you have next time Max can teach you what is ROE. That basically means if the money they don't distribute to you, they decided to keep yourself, they have very low dividend payout, how much do they earn with the money that they keep. And in Singapore, there are a lot of very, very cheap company. For example, like this global testing, right? You can see their stock price. It's really nothing fanciful, right? 0.97 until 1.16. But I tell you, these stocks have capital returns on over 600%. Why? Because they give away all their money. This like I mean 5 years 600%. So as you can see, this one is just the regular dividend, but on top of that, they have the capital reductions of 0.1, which is times 2, 18%. This one also like more than 2 times, like maybe 20%. So they just give every single dollar that they earn. And you can tell that although they are small company, do they act in the investor interest? I would say they act in the interest of investor. And let's see how much it trade. So currently is in the PE of 2.5. I think it's quite cheap, but this is not financial advice. Please do your due diligence. I'm not recommending this stock. I'm just show you a case study. And this is a semiconductors stock. It is cyclical, and their pricing power is in the downtrend, right? But as if you are long-term holder, maybe you could consider. Yeah. So let's move on to the other case study. From time to time I will like write some articles about a really cheap company in Singapore market, like this company, Geoenergy, is a coal company in Indonesia, but it's listed in Singapore. So what it does is that they buy a land and they hire the operator in Indonesia to to mine the coal from for them, and they sell the coal mainly to India, China, South Korea, Thailand, Philippines, and Indonesia. And so why is the stock trading at such valuations? Is because obviously the coal price has up significantly these 2 years due to the disruptions in Europe, mainly because of the war in Russia and Ukraine. So as you can see that the this stock and the coal price chart, these two charts looks very similar. I would say the stock price, maybe come out a bit slower, but go down a little bit faster. And all this thing is analytical, so it's about the correlations, some report from the demand, talk about demand and supply. If you're interested, you can go to investor1.com and look at it. So I also use the Share Investor, the platform, the Web Pro, to look at all the financial histories. Like say you need to look at what the company does, not what they say. So it is good if you have like 10 years of history and you can sign up some platform, not just to, if they just have 5 years historical fundamentals, just don't sign up for that. Sign up for the platform that have 10 years fundamental, like Web Pro. So it's basically just look at the ROE. So the ROE, the coal company has a very volatile earning because it's dirty, and because everyone nowadays talk about ESG, so environmental like responsibility something. Since I'm not that rich yet, so I don't have to care about that ESG. Let the rich guy worry about it. I just want more, want to be richer, so I invest in the dirty company like coal. I once invest in it. Now I'm no longer the shareholder. So the interesting about is that the market cap, the whole value of a company, when it is traded in Singapore exchange, is traded at 433 million. But as at December 2020, its latest financial report, it has a net cash of 308 Singapore dollar. So when you're buying without after this, and the company have no debt at all, right? It has no debt. So when you're buying the 433 million, it has already like 308 million over there. So you get this, you buy with this price, you already have this much money, and you enjoy the rest, and you get all the business probably for only like 70 million. Yeah, 70 million. And how much does the company earn? Let us check. So last year, the company earns 217 million last Singapore dollar last year. I think that is pretty good deal, if you ask me. Pretty good. In Malaysia, hope that they have this, like the stock this cheap, in Malaysia. And so let's look at what the company does. Look at how they trade the share investor, shall we? Let's look at 10 years. So when they earn money, they when this company started quite rough during 2015, they're losing money, you know, because of coal price. And when they earn money, starting 2016 and 2018, they actually, when they earn money, they actually always distribute it and see how much they distribute. Let's see in this chart, let's check dividend payout ratio. Dividend payout ratio is like, for example, is if this, you can see that is 0.376 during 2016, right? So it means that one if they earn $167, they give it to investor, and this is what the ratio stand for. And over the time, I would say they did okay. They always give the investor their money back reasonably, and if they decided to keep some of the money, how much money they earn with it. So this is returns on equity, means that the money they keep, they don't pay out the dividend. So they actually, the money that they don't pay you, they actually earn you, you know, help you to earn 17% compounded on the 2016. And next year, it helped you to earn, like, if they keep $100 of your money, they earn $23 on 2017. And the next year, you know, 10%, and they lose money for 2 years again. And 2020, they're luckier, 43%, 51%, and 39%. Yeah. And the how about their dividend yield? So 6%, not bad. 3%, okay lah. 6%, okay, also good. 6%, okay. So 37%. All right, I was there, so lucky me. I sold it already. So 21%. Yeah, that is, I think they pass. I think they passed the first test. They treat investor with integrity. And when you invest outside US stock, if you invest in small cap, please remember rule number 1, check with what, look at what they do, not what they talk about, right? Look at what they did and look at their history. Always check their integrity first. And that is the my experience, honestly. Yeah. So Singapore have this kind of wonderful stock for you to look at. You know, that we have really not, Singapore is so small. There's so many little people over here, you know, just a small island, not like Malaysia. Yeah, so you have likely less competition. So sometimes there's an inefficiency here. Whereas in, you know, US, you just can't find something, you know, you have to be extra smart, go to Harvard, go to MIT, you know, you have to really beat the market sometimes. Darren, actually, sorry, how much longer I have to talk?
Okay, I think thanks Vincent for sharing, Sheng Siong, and also just now the stocks, right? So maybe let's take a look to see is there any questions. So If you have any questions, then you can actually put it into Q&A. If not, just to I have a question, Vincent, to see. So normally for the mid and also small cap, right? So which are the financial ratio that is you think is most important when you evaluate a stocks?
As I say, is ROE. Let me explain. Let me share again. All right. So let's use the Sheng Siong as example. Like you want to check the integrity of the company, and you also want to look that every dollar that they keep, they have the best interest they have your best interest in mind. And ROE, beside using to check whether the management did their job or not, you can also check their business natures. In this article, Investor One, you can check out this article, DuPont analysis. In this case, is Sheng Siong. Sheng Siong is one of the three major supermarkets in Singapore. And so in this return on equity, return on equity, DuPont break down those into three components. These returns on equity you can break down into three. So net margin, leverage, asset turnover. A company can increase their ROE in three ways. And also by studying this DuPont analysis, you can understand how the company make the decision based on the financial. So if net margin, so of course, Sheng Siong, they cannot sell their products, like maybe Apple, like a liquor company, they cannot like charge if their cost is 70 ringgit, they cannot sell it like 700 ringgit. They have to just have a very thin margin. So net margin, Sheng Siong as supermarket, if they want to increase their ROE, maybe they cannot, so they go to leverage. So leverage, as a supermarket, you can't really borrow too much money, obviously, but like bank, they also can use other people money. So they get the cash from you first. They sell they sell you, like for example, the shampoo, but they actually only pay their supplier a lot later, after you pay the cash after they send their the supplier send a shampoo, they put it on a shelf, but they don't pay their shampoo supplier only after like in this case, average day payable 79 days later. They only they pay it to their supplier. By then the shampoo is already gone from shelf already. They already collected their money. So this is how they use their leverage, but it has limit. It cannot borrow like too much. So the third one would be asset turnover. So asset turnover is how much you turn over your stocks. This hypothetical example, if Sheng Siong sell 1,000 shampoo bottles every month, while furniture store next door sells only 4 chairs every month, although the chair have a higher profit margin of $50%, earning like $100 per chair and making like 400 in total. But the shampoo bottle each only earn 60 cents and have a faster turnover and generate a gross profit of 600. So although they have very thin profit margin, they sell a lot of shampoos, they sell a lot of their goods, groceries. They earn money this way lah. For example, the most famous, the best retailer in the world is probably Walmart and Costco in US. They have even less profit margin than Sheng Siong. Sheng Siong have 10 profit margin. If I not remember wrongly, Walmart have 4% profit margin, and Costco probably 2 or 3 net profit. But they earn a lot, but they just need scale. They need scale in order to expand their business. They need very, very high turnover. They are expert in turnover speed. That's why they are such a big company. Unfortunately, Singapore is a small country. There's no space for them to grow. Yeah, that's all.
Thanks, Vincent, for sharing. All right, so I think today is also almost the time already. Thank you so much for Vincent coming over and to share your views and how to actually look into mid and also small cap stocks. All right, so let me do a screen share also. Okay. Okay, so so today, actually, Vincent just now also mentions about Singapore stocks, and the case study that Max shares, right, is actually also a Singapore stocks as well. So let's say if you are interested in to invest in Singapore market, so these are some of the brokers, local brokers or foreign brokers that you can actually reach out to them and to ask them to open up a global trading for you. If you are interested in trading Singapore stocks, all right? So there are two things I want to share with you. So first of all, it's a Telegram group that we have. It's called Stock Market Buddies. So you can actually scan this QR code and to join for the Telegram group. It's totally very interesting conversation over there. We will actually discuss about different stocks. We will share different opinion towards other stocks. So let's say if you want to have any questions regarding any stocks, right, you can actually let us know as well. So we will discuss further over there. All right. And also you can join Investing Note as we are the largest investor community in Singapore, in Malaysia as well. All right. So thanks everyone for coming over to these tonight's sessions. So I believe that tonight we have Max and also Vincent to share with us about a lot of different knowledge. So today we will be until here. So we will see you again in next round. All right. See you. Bye bye.